Many traders have probably come across the terms premium zones and discount zones, yet only a handful truly understand how to trade them. That's why, in today's video, we'll break down what premium and discount zones actually are and how you can apply them in your trading. So, let's get started. But before we dive in, if you find any part of this useful, don't forget to hit the like button. And if you're new here, make sure to subscribe and enable notifications so you never miss our future uploads. I'll catch you right after the intro and disclaimer. So, first, let's break down supply and demand. There are two primary groups active in the market: buyers and sellers. When the market rises sharply near a certain level, we assume that buyers have stepped in at that point or area. In the same way, when the market rejects a level and drops beneath it, the decline happens because sellers are active in that region. This means that when prices are low, buyers prefer to purchase at cheaper levels to secure profit. As a result, the number of buyers increases in that zone and demand grows. When demand surpasses supply, buyers are even willing to purchase at higher levels, pushing prices upward. On the other hand, sellers profit when they can sell at higher levels. Whenever the price becomes overvalued, or in simple terms, when it rises beyond a fair range, sellers take advantage by selling at inflated prices. This causes fewer buyers and more sellers to appear, making supply greater than demand, which leads the market to decline. This principle of supply and demand is essentially what's referred to as premium zones and discount zones in the smart money concept. The names may differ, but the underlying idea remains nearly the same. Let's dive deeper into this approach. As we've seen, when prices are low, buyers usually prefer to buy, while at high prices, sellers prefer to sell, both aiming for better profits. Now, in this chart, after taking support below and rising sharply, the price reaches its resistance area and then starts to move down. In such a case, if you want to buy, you must first identify the premium and discount zones for this impulsive move. For that, we'll make use of the Fibonacci tool. By applying the Fibonacci tool from the swing low to the swing high, you'll notice a 0.5 level marked on the chart. The zone above this 50 line is considered the premium zone, while the zone below it is considered the discount zone. The premium zone usually forms close to the supply area, where many sellers exist in the market who prefer selling at higher levels. That's why we call it the premium area, favorable for sellers. The discount zone forms near the demand area, where buyers prefer purchasing at lower levels to maximize their profit potential. Therefore, your goal should be to buy in the discount zone and sell in the premium zone. Let's now examine some examples on the charts. This is the 5-minute time frame chart, where the market is attempting to form support below the 24,150 level, while also rejecting higher levels. This indicates that a demand zone has developed at the lower levels, while a supply zone has formed at the higher levels. Now, if you connect these 2 points and apply the Fibonacci tool, you'll see that a premium zone has formed above the 50 level, and a discount zone has formed below it on the chart. Looking closely, whenever the price enters the discount zone, buyers step in, creating buying pressure as demand increases. This pushes the price upward from these support levels. On the other hand, whenever the price moves into the premium zone, sellers become active, increasing supply and driving the market downward. Typically, sellers place their stop losses above the supply area, while buyers place theirs below the demand area. To defend these positions, both buyers and sellers react strongly whenever the price tests these zones. As the market opened on the 27th, the price approached the 50 level and then moved down into the discount zone. Seeing this, buyers became active again, and with increased demand, the price pushed higher. Many positional buyers already had stop losses in this area, so they added positions to protect them, while fresh buyers also entered long trades, placing stops below the demand support. This combination of demand outweighed supply, and the market moved upward. Similarly, when the price rises into the premium zone near the seller's stop loss levels, existing sellers add to their positions to defend them. At the same time, fresh sellers enter the market, increasing supply and pushing the price downward. As long as the market remains in the premium zone, you should avoid heavy buying, because your stop loss will be much larger compared to your target, and the probability of hitting profit is lower. Likewise, Short selling should be avoided in the discount zone, as buyers dominate here and demand is stronger, increasing the chances of your stop loss being triggered. However, if the market breaks above the premium zone and sustains there for some time, you can enter a long trade on the breakout of the previous swing high, since the premium area below will now act as support. In the same way, if the price breaks below the discount zone and trades there consistently, you can enter a short trade by treating the discount area as resistance, with a tight stop loss. That's it, traders. Thank you for watching. Success doesn't come to those who wait, it comes to those who take action. Start your first step today. If this video added value, hit the like button, and if you're new here, subscribe for more. Don't forget to turn on the notification bell so you never miss our latest uploads. I'll see you in the next video.